Hello, Culture Matters podcast. Before I introduce you to our guest, this is going to be a doozy. Here's a quote just for this episode. It is incumbent upon each of us to improve spending and savings practices to ensure our own individual financial security and preserve the collective economic well being of our great society. Ron Lewis. Our guest today, frequent friend of the Culture Matters podcast, advisor, mentor, founder of All Things Insurance Group, the one and only Pete Fournier is back to talk about life, business, financial success, personal development. I got a million questions. Thanks for coming back to the Culture Matters podcast, brother.
Absolutely. Appreciate you, man. Thanks for having me back.
We got so 20% of 2025 apparently is over.
Disgusting.
What do you say to the person sitting at home in their underwear? They just finished their third Netflix show and they accidentally clicked on this.
Dude, it's like if you're like any entrepreneur or like even not even entrepreneur, you could be a W-2 or whatever, but like 5 seconds ago, everybody was writing down their goals during the holidays of like lose 15 pounds, start a business, make more money, and we're a quarter of the ways in, and I bet no one did anything. It's insane.
What's worked for you when it comes to planning and executing and balancing the two and to actually achieve goals?
On the planning phase and the goal phase, like first of all, you have to, it's imperative to actually want what you're planning for. Like some people you talk to, and like I see it a lot in my insurance business, I'm hiring young, savvy entrepreneurs, hopefully, and you're like, hey, what do you want out of life? And they're like, I want a Lambo. Like, do you really? Or do you want like to pay off your student loans? Do you want to, not eat ramen noodles anymore? Do you like what's the actual goal? Because then you'll actually plan and want to achieve it. The other thing, and I think we talked about this either last episode or a couple episodes ago, was uh, planning with the end in mind. Because if you come up with the ultimate plan, I want to sell my business, I want to exit, I want to make $100 million, I want to do this, I want to do that, I want to build a theater, like I'm just spitballing mine right now. Well, then you can effectively take steps backwards towards that ultimate end, if you will. And those plans are finite, they're regimented, they're granular, and it basically gives you a blueprint on what you want to do. If your goal is like, I want to hit the gym, okay, once you're there, what the hell do you do? Like, do you want to grow biceps? Do you want traps now? Do you
Mm.
want to lose your gut? Like, what's the point? So I think that's been effective. Like, and I used to be shitty at it too. Like, I used to be like, I want to be rich. What the hell does that mean? Like, you have no idea, you know?
Mm. You know, all of the thousands and thousands and thousands of people that you've just done discovery with over the years that are seeking financial security.
Mm. Hmm.
What are some of the common questions that they ask if their end goal is security? Some of the questions.
I find that you're talking in terms of client base that
Yeah,
I
the
help.
everyday people.
Yeah, I feel like security means a lot of things for a lot of different people, but ultimately, when they walk into my office or I meet with them at their house or whatever, they don't know what it means yet. So I usually preface it as, listen, there's really two types of clients. There's a million ways to skin the cat with the financial security side of things in terms of products and, everybody's got opinions, but ultimately it's, hey, are you in preservation mode? Meaning, do you want, let's say, a pool of money to grow safely and conservatively year over year over year? And you can look at that pool or that portfolio and it goes up and doesn't really go down, and that makes you sleep well at night. Or does financial security mean to you that you can't outspend your money? You have a never ending river of money flowing to you, whether it's hundreds of millions of dollars or it's 5 grand a month to cover your bills. And does that make you sleep better at night? You don't really care about the lump sum because maybe you have budget problems or whatever. You just want to see the flow. And that's kind of where we start from a financial planning or a financial security conversation is what type of person are you? Do you want to see $1 million somewhere sitting and growing? Or do you want your bills paid every month without thinking about it? And we can do either one for them.
What fears do people have?
Outliving their cash, especially when I do like financial wellness seminars and stuff like that. We, in today's day and age, if you are married and over the age of 60, you have a 40% chance, one of you, to live till age 93. As statistically speaking, from Social Security Administration website, you can see like amortization tables and stuff. So basically, when we're planning for financial wellness, we have to work backwards. Again, looking at a end game, we have to make sure you don't run out of money starting at age 93 and working backwards from that in terms of the plan. Because with modern medicine and people hopefully getting on health kicks in 2025, like longevity is a serious good thing, but also a problem. Unlike when Social Security was first enacted in, I guess, 1935, right? FDR signed it into the average life expectancy was 61. So people were paying into Social Security and then dying and not getting any of it. Now it's the opposite. Oh shit, I'm living too long. I don't have enough money to plan for that. So it's weird how that dichotomy has taken place over the
Wow.
last 100 years, you know?
Hmm. Hmm.
And it is scary to see the lack of one education, because I don't think any institution did a good job of prepping us at all, whether it's high school, college, even your boss or your career. Like just shove that money in your 401k and you'll be fine. And then they look up at 65 years old and they got 150 grand sitting in there. And they're like, what do I do? Like, oh my, that's the most terrifying thing in the world to me. And sad, sad, sad.
People ask that.
Yeah. Like, what do I do? How do I fix this? And like you feel terrible because you're like, like there I need something to work with. And unfortunately, people were given the wrong advice or no advice at all throughout their we'll call them the multiplication years, between
Hmm.
25 and 55. They were either instructed incorrectly or not instructed at all. And now they're close to the end, and it's like, all right, what do I do? Well, you got to scale back everything and pray to God to live off of Social Security and whatever savings you got, and that's it, you know, which is horrible.
What would you say are the if there's like archetypes or a certain type of person that's attracted to more of the is it like fixed returns when it comes
Yeah,
to the
yeah,
returns
fixed
world?
or like 0% floor, like an annuity, let's say, right? So like fixed indexed annuity with upside growth or maybe a fixed rate of return. Hey, you're getting 6% for 20 years or whatever it is. I would say like from a
What's fixed rate mean?
so a fixed rate, and let's say in this case, an annuity, right? Means they're guaranteeing a fixed rate of return guaranteed for a certain contract period of time. So they may say, um, like for a MIGA, which is a multi-year guaranteed annuity, it's like a CD kind of. They may say, okay, give us insurance company says, give me money, lump sum. I'm going to hold it for 3 years and I'm going to pay you 5.25% on that money for that 3 year span, and then the contract period's over and they walk away. Or it's longer. Hey, we're going to guarantee you 6% for 25 years. And you got to keep it in there for at least 10 before you can touch it. There's all these different caveats. But really, there's two ways to go about it. There's indexing, which has higher rates of return, 0% floor, and then there's fixed rates that just continue to accumulate. But the type of person, one I would say is like the antithesis of a gambler. If you're a conservative, risk adverse person, and again, what makes you sleep well at night is knowing, hey, I might not be getting 18, 20, 22% returns year over year, but I'm also not gambling 18, 22, 25% returns year over year. So they'd rather just see the consistent growth as long as it hopefully outpaces inflation, knock on wood, they're good. It also stems from a salary and a net worth perspective. I feel like somewhere, and this isn't everyone because I have really, really rich people that do it for different reasons, and I have some, not so well off people at all do it for some reasons. But I would say from a net worth perspective of like maybe a quarter million upwards to like 5, 6, 7 million, anywhere in there is just a part of the 90% avatar of people that we deal with. So between a quarter million bucks and maybe 5, 6, 7 million, on the upward side of the scale, they're wealthy enough um, where hopefully they don't have to worry about too much and they're not living above their means in their 60s, 70s, 80s, and 90s. But they're not in that like ultra rich bucket where it's like you got to take necessary precautions to make sure you don't gamble this stuff. Because as you and I know as business owners and as consumers in America, like you could spend $1 million pretty fast if you wanted to, just from a consumption standpoint. So they're not super affluent where it's like, oh man, I can stick my money in a fixed rate account at 3% and live forever. Like they still got to make sure it grows and they got to hold on to it. Outside of that, maybe upwards of 10 million plus, they usually have multiple investors. Maybe annuities are a small part of their portfolio, but it's not as needed at that level of wealth.
Uh, well, how did they come into existence?
Funny enough, so I'm a big Greek mythology, Roman mythology guy. Like if Greek mythology was a major, I would have taken it. And it actually stemmed in ancient Rome back in the day. So the Romans, and don't let me mistalk general public on Roman history because I'm no buff. That's why I sell insurance, but I like it. And they came up with the idea when they were either fundraising or trying to build, and I've been to Rome, build one of these fucking crazy structures. What they would do is they would go to the general population, usually like the Senate and the wealthy first, and then they would go to the populace and do it. But they would say, hey, give us a lump sum of whatever they paid in Roman gold medallions, right? Maybe give us 1,000 of these or whatever the number denomination was, and we'll give you a drip payout of whatever it is, 30% more than what you gave us over a 4 or 5 year span. So it started in Rome, then went to like medieval times when a king or a monarch was trying to build their castle or expand their kingdom. They would do the same thing. They would go to the general populace and say, "Give me a lump sum of X, and I'll yield you Y, but over the course of so many years." And the modern ones that came into existence in like the 18th and 19th century and so on were from insurance companies and from the government because like technically you could say like a bond is a sort of annuity, right? Your grandma gave you $100 savings bond when you were like 8 years old and you had to wait 20 years to make $5. Like that's shitty version of an annuity, but it's still there. So started in ancient Rome, and then the really like the ones we know of today came around in like the 17, 1800s.
Hmm. How, um, what about like, let's say if you're going to look at potential downsides for those that are listening.
Yeah,
Example, like, uh, I, you know, Mary Smith goes all in and walks across train tracks accidentally. You know what I'm saying? Like, what are
sure.
potential downsides in your mind, or potential scenarios where that becomes a risk?
So, not so much in the death aspect of things because they all come with a death benefit, and most of them can be liquidated plus interest very fast in terms of a death. Obviously, it sucks for that person that passed away, but the beneficiaries can reap the rewards. First and foremost, downside of like, let's say an annuity, whether it's a fixed product, it's variable, or it's deferred, whatever, is opportunity cost, right? Maybe you're in index funds that are yielding 6, 7, 8%, and the market's going gangbusters and you're not getting 40, 50%. But are you the type of person that, I don't know, plays penny slots or plays, $500 hands of blackjack? Like what is the opportunity cost that you're giving up in terms of the risk reward that you can get from the safe investment? So we work with our clients to navigate that because we also don't want all of their portfolio in one single annuity. That's not
Why
diversified
not?
because you are locking all of that money up into a contract for X amount of time. It's not necessarily very liquid. A lot of them come with 10% penalty free withdrawals and stuff of that nature for emergencies, but you are locking up those funds. And just like any well rounded portfolio, many of my clients have an annuity portfolio. Some are more strategic towards excessive growth with buffer fund surrounding it. Some are fixed, some are deferred, some are income based. So if they put everything, and I saw a client the other day at 550,000 in one single contract that they've had for 6 years, and it isn't yielding more than like 2% a year. One, that's a shitty agent. And two, like people tend to set it and forget it without monitoring it. And that's both the agent's fault and the client's fault. So if you have all your eggs in one basket, very hard to get out of it and diversify.
Um, what are statistics? Are the percentage of people that actually go that route to make this type of vehicle a component of their lifestyle or their future benefit? Are there,
So there,
you know,
there
like out of the 365 million people in the country, is it a very
So
niche
I I will say that
pool?
like there has been a drastic uptick, which is good for me, but also a drastic uptick in the market since 20, I would say since COVID, really, of these people got shattered like they did in '08 and like they did when the towers fell in 2001 and so on and so on and so on. But I remember '01 because like my dad's 401k got absolutely destroyed, right? And it's the law of never
Wow.
going backwards. So they saw a 40% hit in their portfolio during COVID, let's say. Well, you need like a 45 or a 50% upswing just to get back to baseline. And these people are 65, 70, 75 years old. So we saw a huge
Huh.
uptick just in the market in general. I think there was a 30% increase year over year over year. Don't quote me. It was either like 28 or 30%. I was reading a Barron's article the other day. Increase year over year since COVID of annuity sales because people just don't want to mess with it. They're at the tail end of their life and they're like, hey, I want to set it and forget it. If I yield 6%, at least I'm trying to outpace inflation.
What do you think, if at all, this vehicle has the relationship this vehicle has with people's people's trust in markets?
Yeah, there's definitely a lot more mistrust now than there has been, I think. Now there are also clients that I sit with and they're like, I've been killing it since, 1999. Okay, awesome. Good for you. You're smarter than 99% of the people I talk to. Cool. But for the most part, there is a twinge of like, maybe I still want to be invested. Like I have to go to a client's house tomorrow. We're only taking 20% of his portfolio and putting it into a fixed index product to allow for future growth and 0% losses. But even still, he was like, listen, I know that I can do okay on my own, but like if shit really hit the fan, this 20% we could live off of, for 5, 10 years to let this recoup. So just like all insurance, because it is an insurance product, it's just a hedge, right? Against everything else. You wouldn't want to put all your eggs in a annuity basket either.
Those that do, why?
Yeah. So there was a study done, I think it's the National Institute of Retirement. And in 2022 or 2023, they did a study and it polled like thousands of seniors over the age of 65. And all the poll was if you could go back in time and enroll immediately in your 401k and take the match and do whatever it did and whatever, or your company said you will get a pension for the rest of your life If you want to invest more, you can, but this is what it's going to be. Which one would you want? And over 90% of seniors said, I would rather take the pension. So that's the mentality that we're living in right now of I
Wow.
want those automatic systemized withdrawals. I want my social security payment. I want to know how much money I'm making on a monthly basis. And arguably, yes, can a financial advisor model that for you? Sure, on a portfolio. Like and be very close, right? Was it there's multiple methods of figuring that out. However, a lot of people just want to be able to set their watch to it and say, this contract says I'm getting X a month. Cool. I'm out. I'm doing that, and that's it.
From an emotional standpoint, what do you see from people when they think about their future and they believe it's, they're going to get a fixed, all right, this is what I'm going to get 20 years from now. Because the reason I'm asking this, I'm thinking the person that bought high and sold low, maybe they
Mm.
didn't listen to advice, they're not going to listen to anybody. They're not going to listen to their, I have a trainer. He told me, like, work out when you're not with me. But I didn't because I had an, I'm tired. You know, I'm tired. I don't want to. I'm not that heavy. I have all sorts of reasons why I'm not listening to
Yeah.
Michael. If you're listening to this, I love you. So like his heart is in the right place. He's been compensated. I'm just, but, in that context, definitely, I think, he should fire me. So the question was like, what have people said to you in the past about how they feel? You
I
know,
would say a lot of my clients are slightly at like no one really comes in. Well, I shouldn't say no one. I do have two appointments tomorrow where they were like, I want an income annuity. So very rarely, but like few and far between do people come in, they knock on Pete's door and they're like, yo, dude, I want an annuity. Like it's got to stem from a lot of the times it's a psychological factor. Like they're a little weary of it. We just go through the motions, we outline the product, and if they want to enroll, great. And if they don't, that's okay too. Like it's not a forced sale. But the nicest letters I've ever gotten or thank you cards from clients were, hey, we've been pulling on this thing for 3 years, 5 years, 2 years, whatever. And we want to thank you because you didn't ram it down our throats, but you outlined all of the options. And just knowing that, like, we don't have to worry about the bills every month, like that section of our life is done mortgage, interest, taxes, groceries, whatever. It's so much more fulfilling to be retired versus like I'm worrying every day, oh my God, should I buy this? I know it's only $100 and I got 300 grand, but how will that affect future? Like, there's none of that with this style of product. So, yeah, again, very few and far between do we take like almost everybody's money and put it into something like this. But it's a lot of the times for the people that need that regimented budget that makes them feel good. Because psychologically speaking, I know I'm like this when I get paid commissions, my money goes into 15 different accounts because if I see like $1 million sitting there, I would spend like an asshole. That's my like I know myself. I have enough self-awareness to know that. And a lot of consumers, especially retirees, are like that. I never had the Corvette. Let's go lease one. I want to be closer to the kids, but the kids live in San Diego. Well, screw it. We're going like to live out our life. Like that stuff can happen very easily if you don't have a regiment, put into place.
how did you, been in the industry, a decade and a half plus?
Mm-hmm.
How did you originally get introduced to this component of your industry?
It's very funny. I was cynical about it initially. So this had to
Really?
be 8, 9 years ago. And it is funny how like you mature in so many different facets. My thing was, let's say 8, 9 years ago, and I was 27. I was making really good money for a 27-year-old. And I was investing in the market and I started getting into crypto and I was flipping Pokemon cards and like all this bullshit. And like everything seemed to just be printing money. everything made money, no worries, whatever. And when someone was like, dude, you're so theatrical, you're very good, well spoken, you should start doing annuity seminars. I was like, who would buy that shit? Because like
Yeah, that's
everything that
perfect.
I knew about the product was like, oh, that's lame. You're gonna guarantee somebody 6%. I just made 80% on a Charizard. Like, what are we doing? You know what I mean? Because you couldn't, I couldn't empathize with the client at that point. And then I started doing product reviews and meeting with my clients. And like anything in my space, I asked my clients for practice presentations. Hey, I'm learning about financial wellness through the use of annuities. Could I present to you? And if it makes sense, great. But like, I just need to get some reps in. And these people were saying, like, holy shit, that should be part of my portfolio. And I was like, oh my God, maybe there is a need for this stuff, and then seeking out the people that understood it, they wanted it. This is not a product where I'm like life insurance. Arguably, almost everybody in the United States needs some sort of life insurance, right? Maybe except Elon, but I'm sure he's insured in some way, shape, or form, right? Not everyone needs an annuity. Like it's not like one out there because you're turning 59 and a half and buy one. But like lots of so I'm talking, if I do a financial wellness seminar and we have about 80 people in the room, I would say 50% of them are just interested in having a sit down to say, I've heard a lot of shit about annuities. I've heard a lot of good things. It's just the rumor mill of Google. Like, help me. And just going through that conversation makes me feel good because at least I can educate them on it because I came from that same mentality of, oh, this shit's stupid. Just flip a car or sell some coins or whatever. Like, what a dumb mentality, you know?
Mm. Yeah, how accessible is flipping or selling Charizard at 68?
Right, right.
Hmm. What about horror stories
Yeah.
throughout your tenure in the industry? Like, where does that go too far? Like too much, I eat 10 bananas. It isn't the same as one.
Yeah. I
Like,
so I was doing I thought actually thought about this the other day because I was doing a client review from somebody and they immediately looked up the carrier online and it was like consumer affairs and people were like, this company sucks, blah blah blah. But if you go to consumer affairs for any company on the in the whole United States, you'll find more negative reviews than positive because those are the people that chirp. But I digress. The going like 99% of the problems that stem from annuity products is the agent selling them. The longer and just to give some insight into the industry, the longer the product, if I sell you a 15-year annuity over a 7-year or a 10-year or a 5-year, let's say, I make way more money. So you're running around sometimes and you find these 70-year-olds in 15-year contracts with long surrender periods that just made the agent stupid rich for selling that contract.
is part of that because the money's spread out over a longer period of time and
Mhm.
like a less likelihood of living or like so there's less return in a
And the
sense?
carrier has more like risk diversification, so they could pay you more commission on that product because they're holding the money for so long, right? As opposed to a shorter term contract. And whether there's income riders and long-term care riders, and how bad is the surrender charges, the potential MVA. Like these are not just like CDs where you can set it and forget it. Some of them are fixed rate ones, but majority of what agents are out there slinging on a daily basis are not fixed rate. They have some variance to it. They have some bells and whistles that can positively or negatively affect the client. And most importantly, and this is so short-sighted, we basically get an implementation fee to form the annuity, right? It's a one-shot deal. Yes, insurance agents out there, if you're listening, be like, you can take a trail. Yes, you can. But basically, it's like one shot commission. So what you find is the pay on these are decent, and agents will run around, try to whale hunt, get one or two. They're like, I made more money than I've ever seen in my entire life. These fucking contracts have to be shopped every 2 years, 5 years, 7 years, just like your home and auto insurance, like as something as basic as that. And because they're one-shot deals, these assholes that are slinging them do not go back to the client because in their mind, they're saying, I'm not getting paid for this review. Well, your commission is dragged out over the course of your relationship with your client, is how you need to be looking at it. You didn't make 50 grand in an hour. You made it because you have to be their relationship manager for 15 years. So you're making 4 grand a year off them or whatever it is, you know.
How does All Things Insurance Group, being that it's part of its purpose is to provide all solutions for its customers, solve to that sounds like backwards incentive, financial incentive. As
Yes.
Munger would say, give me the incentives, I'll give you the behavior.
Yeah.
So how does All
So
Things Insurance Group solve to that in
so
your
we
estimation?
on the annuity side of things, we probably have access to like 35, 40 carriers, which like all the major players. I only go A minus and above for the majority of contracts. And realistically, it comes into the sales approach because like I've said no to clients before wanting one because they didn't have enough liquidity. It didn't make sense for them. I would feel bad if they had an emergency come up and they couldn't access to the funds. Like it is very related to their fact finding for the initial discovery meeting on like, this is not a product that you push. This is, oh, I found 11 problems and this product would be the solution. If it's not, and there's only one problem and you could solve it with like whatever, then go that route. But they have to have multiple implications in their financial situation to have them justify uh, purchasing an annuity.
What core values, yeah, if there's core values that almost like undergird the ethical service, what would be the anti-values?
Yeah, selfishness. I would say, right? Is that a value? Right? Selfish.
Yeah,
Uh,
be selfish. Okay.
yeah. Um, Transactional. I don't know if that's a value statement, but somebody that's heavily transactional focused, I would say like stay out of the annuity space. Um, because it is labor intensive and you're not going to do the work. You know, you're just going to see the comp check and be done with it. Um, the other antithesis is like, and I've met guys like this running around like literally door knocking senior neighborhoods for annuities and saying, we have a product with a 0% floor and 18% market cap, blah, blah, blah. Would you like to take a look at it? Dude, it's that comes like in meeting number 2 or 3. That doesn't come in the initial sit down. Like I usually tell people if they meet with me directly, meeting number 1 is a come to Jesus meeting. And it doesn't mean that it's negative by any means, but it's like, hey, bring all of your shit and we're going to walk through what you got going on right now. And if life insurance plays a part, if Medicare plays a part, health insurance and annuity, maybe I refer you to I don't know, credit card consolidation company because I think you need to pay down some debt, like whatever it is, those solutions all stem from that initial 45-minute to an hour discovery. Only later, 2 sits, 3 sits, 4 sits, do you actually get into product breakdown. Like my average annuity is probably 3-ish consultations before we get into the actual meat and potatoes of what we're going to do.
Is there a connection with time invested and quality control in your mind then?
Yeah. Um, so I not so much force it upon myself, but I created that sales process to basically weed out or diminish the ability for anybody to come into the organization and just sling product. Like the
Mm.
fact finder is long as hell. The structure is long as hell. You have to joint work your first 2 or 3 with somebody from home office because you don't know what the hell you're doing and you could ruin someone's financial future. Like all these metrics are put into play for quality control and to alleviate the need for a bad apple to turn into one immediately, you know?
Yeah, you know, how does somebody sleep at night that does destroy someone's future?
It's really insane to think like you locked up, and like I've seen it on the life insurance side, I've seen it on the health insurance side, but like there's something about annuities where like I met with a couple weeks ago, and not like they were in tears or anything, but like they didn't know they were getting so screwed. And it's been so many years. And like, oh, I call our guy, they say we're good, we shopped it. Like, no, you didn't, you asshole. But like the client doesn't know any better. Like, there's no vetting, you know what I mean? So like I had 4 meetings with them before one, I got them to trust me because the other guy flim flammed him so bad. And two, to make sure, guarantee that at least in year one, we were making you whole from leaving the current contracts. So lots goes into it. You can't just be like, yo, you want $100,000 annuity? Like it's just so foreign.
What questions do our listeners need to ask?
Um, So one, and there's
Or
annuities for everybody, but one, you could start looking at them as a solution potentially in your 40s. Anything before that, and this is not financial advice, but like I couldn't really justify selling a 30-year-old an annuity unless they begged me for it, right? But in your 40s, 50s, and definitely in your 60s, you can do things like set up almost self-directed pension plans for yourself. You can get fixed index growth annuities for long-term contracts that have high cap and par rates. Like it's advantageous for that. The other thing they ask about is like fees associated with the accounts, the carrier, have them bring some research to the table. Like I really appreciated the other day. I had someone ask, like, well, what do consumers think about this? And luckily, Newsweek just did an article that said they were the most trustworthy carrier in the world in
uh,
2024. Like, have them bring other things to the table besides just like the quote, the illustration, like what's the carriers? How long have you been in business? Like, no offense, new people, but like my interns, let's say, they're in their 20s. I ain't gonna let them sell one for maybe like 2 or 3 years. Now they can call, set appointments, do a fact finder, bring them to the table, but like there's a growth period to this too. So like, yes, unfortunately, new insurance agents, this is where us vets are gonna crush you for at least your first 3 to 4 years because you should inherently get no's from the consumer. So consumers, if you're listening, if your person hasn't been in for at least 2 to 3 years, that person is not locking up your money. Like that's silly.
mm. Why?
Just because they have no idea what they're doing. And if they say they're bringing their manager or president of the company or whatever, make sure they're not just making shit up and they're actually bringing somebody to the table and you met that person and they do the whole process. Because that's what our guys do with me a lot of the times is like, hey, Pete, I think we have an opportunity. And then
Mm.
it's like, just shut up and listen, and learn. And I'll take them through the process and vet them out.
How do the sales people that are listening, the those in the helping professions, what advice do you have on them on saying no to business or saying no to short-term benefit
Yes. You,
versus long-term gain?
you have to, and unfortunately, I don't know if it's our industry or just salespeople as a whole, but unfortunately, agents do not look 90 days past their freaking face. But just know, like, you are starting this as if you got hired at Apple or Microsoft or Harvard. They're not hiring you expecting you to hang out for a year and then peace out. Like this has to be a 10, 15, 20-year investment.
Mm.
Hopefully shorter if you're good at what you're doing and you sell or whatever. But like there's got to be time spent and knowing that like I don't care how big the commission check is, the relationship will always outweigh that. And the more good you do for people, the referral game is so strong, the goodwill is so strong, the repeat business is so strong. um it would be insane. Like I've made six-figure commission checks because I've done right for somebody's niece or aunt or cousin or whatever. Like if I was a scumbag, that pipe would drain out real fast. It's like wringing out the towel in the bathtub. You know what I mean? Like you can
Hmm.
only piss so many people in the world off because of 6 degrees of Kevin Bacon, right? So just don't take advantage of people. Do right. And if you miss out on a few, like I couldn't justify transitioning one couple's money. It would have made me like $42,000. It just didn't make sense. They would lose, they wouldn't get recoup before year 3 or 4. Like it just made no, I wouldn't have slept
Mm.
well at night. And that's 40 grand. A lot of our listeners right now could probably use 40K. Like you got to be okay to walk away from that. And if you're not, like do some self-awareness, don't sell the product yet because it is too tempting. You don't have to. You make I made a fucking shit ton of money selling life insurance. You don't have to sell the grand slams yet. Learn. Feel okay about it, you know?
Um, and how about from a um, regulatory or like, let's say, a kickback standpoint, a pushback standpoint? Let's say that someone in the industry isn't doing it at the highest ethics. What are possible consequences?
Oh, licenses can be lost. I knew a woman probably 5 years ago now. She had the Department of Insurance banging on her door because it wasn't like you could get one pissed off client and they complain and like maybe it's a slap on the wrist or they do an investigation. And as long as you prove like you did what's right, it's fine. When you have like 25 clients complain,
Wow.
all about the same thing, not disclosing surrender charges, not talking about withdrawal lock periods, not talking about this, that, the other thing. Like that's how you get in trouble. And like again, like in our space, I firmly believe if you're an insurance agent, the state that you are domiciled in gave you a license to just go to the ATM and print money out. Like that thing is everything. So if you're gonna lose it because of some bullshit, don't do the bullshit, you know? And as
Mm.
long as you're doing right, because like I've been in it almost 15 years, like you get complaints, you get pissed off people, like you can't satisfy everybody. But as long as you're doing the right thing and you have proof of that, you can go to the, whoever's coming down on you and show that everything's okay and it becomes fine. It's when you are absolutely in your heart of hearts screwing people over, you'll lose that certificate to go to the ATM.
The curiosity I have around this part of the conversation is all the study, and we have many investors that come on the show that they talk about the same thing. Ben Graham and his intelligent investor, Mr. Market, is
Mm-hmm.
is is a little crazy. It's a voting machine in the short term and a weighing machine in the long term. People act irrational in the market by nature. They might
Mm-hmm.
buy high and sell low. So, in the spirit of, Ben Graham and the irrationality of us people, how does one, a professional, navigate the all that gray area, the emotionality, um, in the sense that, if by and large, part of the reason there are advisors that earn their money is like, oh my God, the world's ending. Let me get rid of everything. I need these helpers to talk me off the ledge, right? Bring me back to reason. As we started the show off, to begin with the end in mind, to think about the future, to plan for the future. How does, someone not blame everybody but themselves, you know, if they're not happy with the product at the end because they're not happy with their life,
Yeah.
the choices that they made in their life. I'm kind of scraping at like, there seems to be a gray area in all of this. It's like very subjective. Like some people, like I was proactive around life insurance because I wanted to make sure that if I died, like my wife had money.
Mm-hmm.
Like so, it's like to me, it's like very reasonable. Like why would I not Why would we not invest a little bit in the off chance that the worst possible scenario happens?
Yep.
Um, thinking ahead. People aren't, I mean, I swear, people by nature, we are not emotional. We're reactive.
Yeah.
We can't plan for everything. There's like a big gray area here. It's like, what type of investment I like, what things do I like, how much do I want, what's the allocation? There's everybody has an opinion. So I guess if there's
That
a question in that, it's what are the ethics? What's the professionalism? What's the discovery? How do you do the best job discovering what's in the client's best interest so they sleep better at night and they're happy towards the end of their life. I get maybe that's the billion-dollar question, but
Yeah, yeah, yeah. I mean, so the first thing, well, the last thing that you just said, opinions are like assholes because everybody's got one. And like, I'm in these networking groups. I'm obviously all over social media, blah, blah. People market like, are you in an annuity? JG Wentworth, I'm in an annuity and I need cash now. Like that bullshit, right? That was against, right? Having a long-term annuity and getting cash. So there's always going to be negatives. There's always, you should invest in the market. You should have 30 units before you're 30. You should have this, like all these fucking sound bites that like we have so many things coming at us on a daily basis. You have to sit down with at least someone that you have a little bit of trust in, whether that's new trust and you're gaining a lot more. That's why I like financial wellness seminars because I gain a little trust in the room before they actually come and see me, right? And I know what I'm talking about with Q&A. So sit down with somebody and really discuss from a consumer point of view, like what do you want and why? It even goes back to the entrepreneur. Like, what do we want and why do we want it, right? I want to be rich. Why? So I can take care of my family. Something so elementary, right? Same thing for the consumer. I want to retire at 60. Why? Because my dad died at 63, and I don't want that to happen to me while I'm working. Okay, that's a great why. How much money do you need to retire at 60? Do you want it guaranteed? Do you want it variable? What's your risk tolerance? Here are three buckets: aggressive, medium, conservative. Where do you fall into play? And you just start playing these. It's almost like analogy game show with them,
Mm.
right? To deduce what they actually want, because the consumer themselves, and this is maybe more for the insurance agents that are selling financial services products, they will deliver sound bites. I heard annuities stink. What'd you hear? I don't know, but that they stink. What? Or my advisor said you need to be in ETFs. Why'd he say that? I don't know. He just said it, and that's all I've been doing. Holy hell. So, like, there's got to be a why beside every decision. And if that makes sense for you, then do it, right?
what percentage of all over the years, like if just even intuitively, percentage of the people even have financial advisors?
Maybe 25, 30%. And I don't want to shit on any specific brand on this show, but it's more so the guy on Main Street that has a fairly popular name of a company that might be a franchise or whatever. And like, how much advisement is that person really doing? No offense to them, but maybe this person is $250,000. And how much advisement can the person even do for that person? Right. Or it's, hey, I'm putting you in this software and it just rebalances your shit every quarter. Call me if you have complaints. Like, just like every industry, financial
You're
advisement,
saying less than 30%,
I would say, yeah,
so 70% of the population, they're completely just on their own.
yep.
Wow. I mean, the fact that
And
that's
on their own,
maybe an
even more
anecdote.
dangerously, on their own with Google and ChatGPT.
Pete, if there's one thing that you would like ask a listener, having listened to this episode, being exposed to this topic, you would ask them, to put them, forward in this conversation, what would you ask them?
We cut out for a second. What would I ask the listener?
Yeah, yeah, to move them forward in this topic.
So
So they're proactive, and we started the conversation with how to plan to execute.
yep. So where do you want if we're talking about retirement planning and the use of my product specifically, it's where do you want to be? When do you want to be there? And what happens if you don't make it? Where do you want to be? I want to have $1 million in my portfolio. When do you want to have that? 67. Why? So I can max out Social Security at my full retirement age and get my pension and have this portfolio. Cool. What happens if you die at 52? Never thought of that. What happens if you get to 67 and you only have 200,000 in your portfolio? What happens then? Right? You start actually making it real for these people, and it's not a sales tactic or a scare tactic. It's this is what we plan for. This is my sole job, right? To hedge risk. It's what I do for a living every day. So those are the three most important questions to ask yourselves, whether you're making 10 grand a year and you're a high school student, whether you're an entrepreneur, whether you're slinging ice cream or insurance or whatever, is where do you want to be? When do you want to get there? And what happens if it doesn't happen? And that
If
that
you're
should be
listening,
revolve around your entire shopping experience with any product.
if you're listening to this episode, remind you this is not financial advice,
Hmm.
but little me trying to learn as a layperson how to make a plan, how to balance execution. What are our options in the future in this chaotic world as of this recording? This month, the market dropped like 6 trillion. I've talked to numerous people, and they're freaking out. And then there are others in my life that are very excited. And the question for everyone listening to this, what's your plan? Or do you have a plan? What's your plan? And who's in your life to talk through it? Pete, thanks for coming back on the Culture Matters podcast. All things insurance group. I got my hat. If you're watching this on YouTube, please share this with a friend that you think needs to get more on these types of topics. Leave us a review in the Culture Matters podcast. We will see you next time. Thanks, Pete.
Thanks, man.